Gary Dean, and I am a co-publisher of TimingResearch.com, and my partner is Woody Dorsey, and he's pretty much a legend in the markets. He's been really doing institutional research for the past 40 years, and he's a pioneer in investor sentiment and market timing. And really, the thesis of sentiment timing is that human behavior is a key deterrent in the markets, and human beings make mistakes, and there's methods of measuring markets in order to take advantage of these mistakes. And that's really what we do at sentiment timing. We have a totally different way of really looking at the markets and evaluating what is going to take place. And we pretty much work on we have a long-term basis, but the majority of the calls are anywhere from 3 to 6 weeks out. And as we know, the way this market's been moving, 3 to 6 weeks can seem like 3 to 6 years. So I want to give you just a little bit of how this all started. And I read Woody Dorsey's book, Behavioral Trading, and I knew when I was a financial advisor over at JP Hanauer, one of his salespeople called me, and I was able to see the work that he did, and I was pretty much amazed at how he was calling when these markets were going to reverse, and some of them were 3 and 6 months in advance, and it was coming down almost to the date. So I read his book, and I ended up sending him an email to see if he'd be interested in going more on a retail end of things. And in May of 2014, we launched Sentiment Timing, and it provides really market insights on near-term basis from proprietary sentiment and timing tools. And what we've done is we've taken his work and combined it with what I do, and I'm more on a technical analysis thing. I look at the internals, I look at the chart patterns, I do Elliott wave, and I'll go over all that in a little bit with it. But human error and market opportunities, and it's really diagnosing the errors and focusing is the focus of behavioral finance, and that's what he does, and with this sentiment timing reports. And it's based on the triunity theory, and that this is invented and created by Woody Dorsey, and it understands that the markets, it's an exact mirror of the mood and the mind of the human beings, and that's basically who is trading these markets. Even though a lot of these they're based off of algorithms and computer trades, but somebody's still programming these trades. And really, the way that this the triunity theory works is you have the mood, which is the psychologists of the markets. Then you have the mind, that's the fundamentals, and the body is the technicals. And we've broken that down into sentiment, technicals, and then market stories. And we created what we call is the predictive analytics model. And the way that that works is time is when the trend is looking to reverse. And these time periods that Woody puts out, and I'll go over a bunch of them in the slides ahead, but they're sometimes, I mean, we have the actual low date that we're looking for in the stock market is coming towards the end of 2021, and possibly even going into 2022. So we have the longer time period that's out there, but in that we're going to have trends within trends, and we have, so I'll show you the top dates and the low dates that were called. And the last top date that we had was actually on June 8th, and that has marked the time period for the top that we've made so far. So the time is when to be expecting the indexes to reverse, and knowing the time period, it gives you an advantage because you can control your emotions, meaning that if you're shorting the market and we're heading into a top date, you have a pretty good idea that this market's going to top. Now there's times that it may not come on the exact date, but it doesn't change the overall dynamics of the market where we're still making some type of topping process. So the time is really the most important piece that we go off of. Then Woody has his proprietary sentiment data, and this is why we're looking for either a top or a bottom. And I'll go over all of this again in the slides ahead. But when we're looking for a top, like let's say the June 8th, it was between June 5th and June 8th that Woody was anticipating that we are going to make a top in the markets. So from there, he has his proprietary sentiment data, and really it's like clockwork where you're going to get the majority of people that are going to be bullish on the stock market at the tops, and they're going to be bearish on the stock market at the bottoms. So we were able to combine the sentiment with the time, and this gives us the why to expect either a top or a bottom. And from there, what we do is we just use regular technical analysis. Now, that's what I do. And I pretty much go off of, I look at patterns, support, resistance, divergences, what the internals are telling us, as well as Elliott Wave. Now, I'm not one of your Elliott Wave gurus out there. I like to really just take the last phase of of a pattern and really use the Elliott wave on that aspect of it. So this is our predictive analytics model. Now, what is sentiment? Sentiment is really just how investors feel about the stock market. And as I said, at the top, because of the let's say the financial media that's out there, they're always bullish at the top, so everybody gets bullish. And when things are dropping, everybody's looking for lower levels, and pretty much everybody gets bearish on the markets. And as long as it's approaching a turn period or a low or a top time period that Woody's looking for, it's kind of giving us that validation that there's a low coming, and that's how we put the whole predictive analytics model together. But it's most indicators are derived out of price. So you have just your regular MACD, your momentum, whatever kind of momentum indicators that you have. Sentiment measures the human emotions of the market, and again, it's one of these the ways of looking at the market that nobody else really can. And we're starting to hear some more people talk about investor sentiment on CNBC or what other stations are out there, but I don't even know where they get their data. I do know of one other service that does sentiment, and it's kind of crazy because they're on this webinar as well. But after that, a lot of these are just getting their data from people coming into a website and saying whether they're bullish or bearish. And the way that Woody compiles his sentiment data is totally different, which I will show you. But extreme sentiment, it doesn't always mean that there's going to be a low or a high. And that's why it's important knowing when these turn dates are. So sometimes when you have a high sentiment reading off of a low, it's confirmation that that low is in place. And again, I'll show you those in the future slides. But they really form they have two different types of formations. Your bottoms are much different than your tops. And what I mean by that is when we're making a top, you can see a series of extreme bullish sentiment readings, and it usually takes 5, 6, 7 extreme bullish sentiment readings before it's actually going to wear off on the market and we see a turn. But typically when we get a extreme bearish sentiment reading, those they in the say for the past few years have actually marked good bottoms, and that's until we just had this big drop in February where we had 50% bullish sentiment readings. And it's something, out of the 40 years that Woody's been compiling this sentiment data, he's never ever seen anything like this before. So we knew that everybody was just throwing in the towel on the stock market, and we did have a time period that we were looking for a low, and from there we just do the regular technical analysis. But you want to look at sentiment on both an intermediate and a shorter term time period. And again, I'll go over that the screens that are above. But the markets always have an irrational element, and the more you understand about these market errors, the more that you can take advantage of these opportunities. And the Woody's proprietary database of stock market sentiment is collected through what he calls daily pollings. It's a process that filters. It's say getting the sentiment from. I'll just give you an example. A financial advisor that has that's managing over 400 clients, and from there, he's then going into the listening post or putting in what his clients are feeling about the market. And that's how these sentiment data polls are compiled by Woody. So let's take a look at how it works. And this is your investor sentiment data polling, where this is the database that it goes into. You have your financial advisors, you have your hedge fund managers. So they're all calling in, or they're all going in and putting what their clients are feeling, how they feel about the market, and that's what compiles the data that we come to. So sentiment is the missing link in market analysis. And as I mentioned before, there's not a lot of people that actually compile sentiment data. And like I said, Woody's one of the pioneers in investor sentiment. He's been doing this for his institutional investors for over 40 years. And it's the only component, it's a component of a market equation. And what I mean by that, it's you really can't just trade strictly off of sentiment, because you'll lose every single time, except when you get sometimes in the past when you get the extreme bearish sentiment readings, meaning those zeros. But if you were just going to turn around and try to trade the markets off of an extreme bullish sentiment reading, you're going to get clobbered, because a lot of times you'll see the S&P go up 200-300 points from the first extreme bullish sentiment reading. And that's what I mean by they have typically the tops with the sentiment, they're around it. They take a bunch of them, and then they will start diverging from what price is doing, meaning that sentiment is actually moving down, or the 10-day moving average on the sentiment is moving down as price is moving up. And it's one of the, let's say, divergences that they're really, really good to understand. Now at the lows, though, those are typically V-shaped. So when you get your 0% sentiment reading, it usually marks a pretty good low in place. So this is really what as far as with sentiment and being the missing link. When you get your euphoria here and everybody is only looking up, and we really just saw that on between June 5th and June 8th, when the topping date was, we had this euphoria where everybody was just ignoring what was going on around them. We had a lot of retail specs that were jumping into this market, and we know that from which is another slide I'll show you in a little bit. But the retail specs were leveraging their accounts with options. And once you get those extremes in this euphoria, when we're in the middle of really a crisis with the economy being shut down, and we're hearing a lot about these, the V-shaped recovery, and something that I was going over with members each night was it's impossible to say whether we're going to have a V-shaped recovery, an L-shaped recovery, because we don't even know what the ripple effects, they haven't even hit yet. We just started, we've seen some states, New Jersey, New York. I'm in New Jersey, but they're just starting to open places just within the last 10 days. So what the missing element of saying that we're going to have a V-shaped recovery is you don't know what businesses are going to be able to stay in business with the let's say the new norm where they're only allowed say 25% capacity in there. And we had when the economy was shut down, as the previous the person I was just talking was saying, the Fed was throwing a ton of money out there. So there was businesses that had money coming in, and as long as they were paying their employees, but that's now pretty much gone. And now we have to see who's going to actually be able to survive this, where you have your restaurants and your bars that have very thin margins to begin with, and now they're only going to be able to have 25% capacity in there. So we have a bunch of those that really aren't going to, they're not going to survive. And then what I mean by the ripple effect with that is you have your retail, so not even your retail but your retail stores, so that you have your landlords that are going to get people that are going to start dropping out, and then from there it's going to then hit the banks. And so when people are talking about a V-shaped recovery and we have all this euphoria in this market, and we don't even have all the elements to say whether it's going to be a V-shaped or an L-shaped, or it's going to go down even further. We don't even have those in place yet. So it's something that I was telling members, where yes, the Fed is involved. They did what they did to hold things up, but unless they're going to continue this purchasing of bonds and trying to keep the market up, trying to help the economy, it's not going to work. And I think the sad part about this is the people that they lured in with this, and really those are the ones that missed the rally going from all the way back in 2010, where they were waiting for the market to come down, and now it's down, and with the Fed involved with things, they're going all in, and that's your retail specs. And the sad part about it is that uh, it, I think we're going to be heading down and testing the lows. I don't think the Fed's going to be able to maintain this purchasing power that they have, because for every action there's a reaction, and it's not just free money that goes out there. It all has to cycle in and out. But in any case, we hit the euphoria right here. We had the big drop, and now we're kind of in this anxiety and denial, where people aren't really too sure what is going on with things and what to expect. So here's a short-term sentiment chart, and this is what would he go. This is the charts that we give our members, and as you can see, these are we notice where when we're coming down, the sentiment readings, and this is what I was talking about when we were making this low in March, where we had 1, 2, 3, 4, we had 5 bearish sentiment readings at the lows, and notice the divergence here. So here's the 10-day moving or 6-day moving average, and notice the divergence. As price was coming down, this was going up, and we were getting this series of 0 bullish sentiment readings. So there is time to start closing out your shorts, because this was where we were looking short. We had this profile that it was at the end of a really a major bull market, and that we were looking for a big move down. Now, this definitely was a little bit surprising the way it happened, but notice where everybody got bullish again at 99% right before the market crashed. So this is where we started heading up, and this is what I'm talking about with just trading sentiment. If you would have gotten short on the first extreme bearish sentiment reading, which was 95%, you'd have been short from 2,500 all the way up to where we made our top at 32.30. So, but this is where you start seeing it and this is that rounding top part where you start seeing extreme bullish sentiment readings. The media is talking about everything that's going well with the market, and yet we're running right into a time period that we're looking for this market to top. So this was we had the June 5th to the June 8th as a top date, and notice where everybody was piling in. Everybody was bullish on this market, and then we had the drop. Once we made the 2%, once we had that big drop, we had a 2% sentiment reading. So basically the majority just switched to bearish. And from there, we've had a nice little rally, which I do believe will fail when all is said and done. So this is the intermediate term sentiment. And here you can see that this is the divergence that we were talking about as we were making this top here. Notice that the moving average of the sentiment was declining, and this was the topping period that we were looking at. And here you can see the divergence on the bottom here. So we were looking for the low, and now we have another divergence, and this is why we were looking for the short-term top. So seeing what sentiment is doing does give you a trading advantage that not a lot of people know or understand or even know how to use it. And that's one of the advantages of working with Woody, is that he's, like I said, been a pioneer of investor sentiment, and he's been doing this for his institutional traders for over 40 years. So let's go over some of the market timing technology that he uses, and this is the trend duration. So if you remember what I was talking about with the predictive analytics model, was knowing when to expect the market to reverse. And really the important part of this, that is a big part of sentiment timing, is controlling your emotions. So when you know that the market's heading up and we're looking for a reversal, and you're seeing a majority of the herd, you want to call them, that are bullish on this market, then it makes things a lot easier, where even if you're wrong, you just kind of just sit on it, knowing that the markets are going to turn either down or up, depending on what we're looking for. But Woody has he has a number of different say market matrix of timing technologies, and there's no one say timing indicator that he uses that works. He combines them all together to come up with these specific dates that he's looking at. And like I said, he has them for a longer term period, and then he also has them for an intermediate term and then a short term. So as I mentioned before, the top date that we were looking at was between June 5th and June 8th. And we already know when to be expecting the low date, but that's only going to provide us a bounce, where the ultimate low date probably isn't coming until early fall, which will be well before the elections hit on that. But then the longer term time period that he's looking at is the last quarter of 2021 or early 2022. So that's where I'm saying that these timing indicators are going on a short term, intermediate, and long term. So it allows people, say you're investors that aren't looking to dive in and out of the market, to know, okay, well, let's just sit tight until we make that major low in 2021 or 2022. Then you have your intermediate people that can just, that got short, say at the February highs, and are just riding things out. They don't want to trade at all. And then from there, we have our shorter terms, where the people are jumping in and out, where, in the March at the lows, we were looking for going into the June 5th, June 8th time period for that top. And now now we're short. So that's pretty much the way these timing indicators work. And this is I'm going to show you what the example that he gives on this, where if you just look at a chart of the S&P, it doesn't really look like there's any trend in place on it. But when you turn around and take a look at this chart here, it's showing that there's time periods of this actual pattern. So there is the market's always telling you something. It's not just a day of nothing. There's always something going on. And if you just pull back and look at a monthly chart, you can see that these timing indicators, they all kind of mimic what's going on. And that's how he takes these times and then projects them into the future. So some of the market timing technologies that he uses is he has the golden halo, and that's a time for a high. It's where the markets look good, feel good, sentiment is bullish. and it's usually accompanied by a high or complacent sentiment. And that's where I was showing you before, where you'll get your extreme sentiment, bullish sentiment readings, and the market keeps going up. But what happens is that golden halo where everything looks and feels good, but there's a major top that's pending from there. The kill zone, it happens right after we start making that hot top, and it's a period in which the market has an overt trend down, and we saw that in February. And it could be a technical breakdown, but it doesn't necessarily need to be the actual high on it. It's looking for a very big drop, and that's pretty much what we saw in the February time period. And the black hole is the opposite of the halo, and this is where we were looking. This is the black hole that took place in March. So the golden halo, this was going on in February as everybody was looking up because the Fed was involved and don't fight the Fed, to the kill zone where we had that move down to the black hole where we had that 0% sentiment readings. And this is where that panic ends, because everybody's just completely bearish on the markets. So the timing technologies tells Woody when the market is ready for a move either up or down. So these are specific turn dates that he gives. The sentiment diagnosis tells Woody the conditions of the market psychology, meaning that if we're at the top and we're in this golden halo, and everybody is just looking up and bullish on the markets, it's confirming that there's going to be some type of top. And the same thing goes on with your black hole on that, where we're making that extreme bottom in the markets. So what I want to go over now is how I incorporate what Woody's information with his timing, his technical timing indicators and return dates with the investor sentiment, and then bringing it to a technical basis. Because as I said, if we have let's say if we just put out the turn dates and the sentiment, it gets confusing for people that don't really have a good understanding of the market or technical analysis, because they're not going to know what to be doing with this information. Like I said, it's we can see an extreme bullish sentiment reading and the market just continues higher. So what I do is I'm going to look at your support resistance as well as technical and internal divergences. So we want to look at these support and resistance zones when we're looking for an actual turn in the market, because one of the biggest problems that a lot of technical analysis that they have is they're going to put their support and resistance there, but we don't have an actual turn date that's scheduled for 3, 4, 5 weeks. So even though we can see these divergences or technical divergences in place, if we don't have an actual turn date that's scheduled, and we don't have extreme bullish sentiment readings or bearish sentiment readings, their trade's going to go bust, and they're going to end up probably covering their shorts if they got short, or selling their longs if they got long. So knowing the time and the sentiment gives me an advantage as a technical analysis to be able to look and see what support and resistance zones are going to play out. So basically the way that let's say a negative, I don't know if you guys are really familiar with this, but we have what a negative divergence is when your momentum indicators are heading higher as price is heading lower. Now we really just concentrate on the S&P 500. So what we're looking for, a negative divergence is when, like I said, we're looking at higher highs on the market, and the lower lows on momentum indicators. A bullish divergence is when we're seeing the momentum moving up as price is moving down. And really what you want to do is just keep an eye on where support and resistance is. So let's take a look at some of actual calls that we've made on this. And I'm just going to go back to say November of 2019. And this is when we were heading into that. We had a little bit of a pullback, and what we were telling our subscribers was that the profile is friendly into at least mid-January. So what that meant was that you don't want to be really bearish on this market. The Fed was involved. The profile was friendly. And from there, you just don't really want to be looking short. You want to be just really riding the wave or buying your dips. So this was what took place, what we were telling people in November. And now let's take a look at what was, I'm sorry, let me go back. So here we go. So this is the where we had the 18% sentiment reading on it. And here you can see that once we got into this January time period, we started getting these extreme bullish sentiment readings. And if I just take a look at our regular chart here, this was January 22nd, 2020. This was our first break. So remember, this is going all the way back into November 5th, 2019, that the market was going to be friendly. So you're able to control your emotions, and what you're really looking to do is buy dips until we start getting into this time period. And from there, I think it was almost a 200, 150 point drop that we saw. And we found support at the 50-day moving average. So this made sense on it because we knew that traders were buying at the moving average on it. But like I said, going from November into January, you were just looking to buy dips. Now, when we had this drop and then we had to bounce up, this is what we were looking at as an ending dialogue to the rally that we made. And this is what we were saying in February of 2020, is it's still best interpreted as a late cycle late cycle equivalence here. So here you can see that we have the 98% sentiment reading, 99, 94. This was all at the top here when we were making this top. This is that golden halo that I was talking about. So we have, everybody's bullish on the market. The Fed is involved and nobody's really looking down. And we were looking at that as the late cycle. So now what we want to do is see what are the internals telling us. And this is your put call ratio. And notice that once we made that top on January 20th here, that we made another top in February, and we had a divergence. So this was an internal divergence that was taking place in the late cycle on it. And we were looking for a sharp move because this was your golden halo. And from there, you can see that we had a massive, massive drop. So if we take a look at our regular charts here, this was the wave structure that we were looking at. So here you have your 1, 2, 3, 4, 5, and anybody that doesn't really know Elliott wave, what basically after your 5 wave, you're looking for some type of pullback on it. Now again, this was a lot sharper decline than I was anticipating. I actually thought we were going to hold right around this 2,800, and once we started breaking down, then we knew something else was in place. But here you can see we have bearish divergences. So we are in the late cycle of this move. We had 5 waves up. We know that we had extreme bullish sentiment readings, and we had a divergence with the put call ratio, and our 5 waves up, and this is what happened on it. So that's another way, how we were looking for the top up in these levels, where we were looking for bull friendly into January, and then from here we were warning about a hard drop that's going to be pending once this wave structure completes. So now let's move it to when we were making the low here. And this is what I was talking about with where we had 5 bearish sentiment readings, 0% sentiment readings here. And what Woody was looking for was he's looking for a minor recovery, but the type of price pattern that fits the best for a swing trade can encompass many S&P points. So we were suggesting here, because we had the 5 bearish sentiment readings, we were going into a time period where we were looking for a bounce, that we were suggesting just, close shorts. Let's start looking for where a low is, because notice that we have the bullish divergences on the sentiment. So again, this is the type of information that not really a lot of people have, because they don't really do investor sentiment. So we can see right here, we had extreme bearish sentiment readings, we had a divergence, and from there, what we were looking at is, here you can see, here's the, we're looking at the, which one is this here? Oh, okay. So this is your put call ratio. We had bullish divergences. So remember, at the top here, we had bearish divergences on the put call ratio. Here we had bullish divergences. So we were looking for the low. And from that point, we had bullish divergences on a 60-minute chart. So this is where we were looking for our low. We were saying, get out of your short positions, because we already had the move. We had bullish divergences on regular technical momentum indicators. We had bullish divergences on the put call ratio, and we know we had an extreme bearish sentiment reading that Woody's never ever seen before. So just to ride your short position was not going to be a smart move on that, and that's why we were looking for a bounce here, and obviously we see what took place on that. So now let's take a look and go to our May 26th call. And what he is talking about here is that the next interim low is due in late summer. But there's two distinct topping dates that he was looking for. That was June 5th and June 8th. So remember, this is almost 2 weeks before all this. You can see that we have the extreme sentiment readings here, bullish sentiment readings. So that's matching the top on it. And if we just take a look at the regular technical or internals here, this is your put call ratio, and it was the highest level that we've seen in 20 years. So what I was explaining before was that we have our spec traders that were involved, and we know that from just really one of the easiest ways of figuring out who was involved with the market was these traders that were bidding up Hertz that went bankrupt. And when you see that type of buying going on, when a company is going to zero, there's no doubt about it, because they've already they filed for bankruptcy, but yet you see it going up some 120%. Those are your retail spec traders. They're going to get squashed. It's just a matter of time. And here you can see that they actually started leveraging to where we had the highest put call ratio in 20 years, and I think it was even longer than that. It was something we've never seen before. So we were anticipating the drop on it, and again, the time period that we were looking at was between June 6th and June 9th. And if we just take a look at what was playing out on it, here's the Elliott wave part of it, where we have our 1, 2, 3, 4, and this was our wave 5. Now, the bigger picture, the way that I'm looking at this is this move down was our wave A. This is our wave B, and right now we're in the beginning stages of the wave C down. Now, whether this is going to come and take out these lows or not, we're gonna have to wait and see on that. But really, the way that we look at things is, okay, so we have our wave A, B, and now we're making a wave C of an A. And my target on this one is really looking right around that 2760 to 2720 level. And from there, I would anticipate that would probably get some kind of bounce, test the 50 or 200-day moving average, and then from there have another move down. And this will take us into the low date that Woody's looking for, and it will probably be accompanied by extreme bearish sentiment readings. So as you can see, we're not just either just going long or short. We have specific targets that we look at, and we combine them with with the Elliott wave, as well as the sentiment and the technical timing dates. And this here was June 8th, and that marked the exact top on this market. And if you remember, that was what he was telling people. That was on May 26th to expect the top on that date of it. So that's really the way that that we work these markets and we start looking at them. And here you can see that this was the top that we made on this part, and you can see sentiment has come down with this big move, but right now we're not looking at this as being over. And if we just take a look at some of the regular charts, this was we had some support that we found down at the at the 3000 level. This is one that I did mention to our members, and the reason why I was saying to keep an eye on that is we had some bullish divergences in place. So we know when to expect this wave C to end. That's the low date. Here where these are just the squiggles as we make it down to this wave C. Now what I would be looking for if the bulls continue to try to rally, which I'm not really quite sure what the catalyst is besides the futures hitting the 200-day moving average and coming off those lows. But really what I would keep an eye on, the two targets that I suggested in the morning notes was look to get short anywhere between the 30.50 and up to the 30.75 level. So when we had this bounce off these lows here, what this was the exact area that I said you want to take some shorts off the table because we had the big drop, and then look to re-add them as we approach into this resistance zone. And this hasn't changed. I've left this the same. And from there, we had another move down, but now we're getting some bullish divergences. So you leave the door open for a test coming somewhere up into this level, but really it's just going to give you a shorting opportunity, because this should be the ultimate end anywhere between there's a gap open at the 2860. So that's one that I'm anticipating, but most likely coming down to this 2760, 2720. Now, if we find resistance at this level and head down, a pattern that I'm looking at is this descending triangle. So this is your lows. If we come down and it holds support at the 2960 and then bounces back up into this 30, say 50, 30.75 level, this is your descending triangle. So these are the patterns that we try to match up with our with the investor sentiment and the turn dates. And the good part about knowing when to expect this low is you're just you just want to be shorting every rally, but you want to be shorting at specific areas. And this is the area that I believe would be the next the short, and that would be anywhere between the 30.75 up to the 30.01 level. So let's get back to these here, and let's just go over some what we're looking at right now is a low date that's not coming in until sometime in July. The top date that we had was looking for June 5th to June 8th. That came right on schedule. And with the divergences, the bullish divergences that we have in place right now, we were allowing for a little bit of a bounce here. And like I said, I would keep an eye on one of these moving averages, because I think there's going to be sellers that are going to be waiting on it. And really the time period or the place that you want to be covering shorts or possibly looking for a long bounce is going to be anywhere between that 2860 down to the 2760, 2720. And from there, we're probably going to get a nice bounce back up into the resistance. But right here, you don't want to trust it, because we don't have any low date that's coming anytime soon. And but you didn't want to get aggressively short because we had the bullish divergences in place. And we know that we had an extreme bearish sentiment reading when we made this quick drop here to 2%. So you let things play out. That's probably the best way to describe what we do. Is you're able to control your emotions, because you know when to expect a low date. You're able to see how other traders are thinking about the market through the sentiment, and from there you're able to see kind of a visual as far as what you should be doing with your trades, whether it's covering short positions or looking to reshort at higher levels. And if you trade options or something like that, it works out great. Futures is a little tough. We don't really recommend it that much, just because of the overnight trading. It's kind of crazy. But the position trades, that the way to look at it is that a rising tide is going to take all ships, and the same as a tide that's going down. Basically everything's going to go with it. So you want to just really be positioning your portfolio that way. But we look at the S&P 500, so you can trade the 2 or 3 time ETFs off of it and just really hold things until we're at support or we're looking for some type of low in the market. So that's really about all I have. What we're special that we're doing right now, as I mentioned, we know our members know when the low date is. The top came exactly on schedule as between the June 5th and the June 8th. So now we know when to expect a low date. And if you're interested in seeing exactly how everything works and how Woody's is one of the best market timers in the world, you can join us. It's only $1.99. It's a 2-week trial, and what you want to do is just go to sentimenttiming.com. From there, what you do is just go to join, and then when you're in there, you just use coupon code 2 weeks, and you'll be able to see all of our reports. What I do in the morning is I do a morning update, and that's really saying what's taking place in overnight trading, whether you should be looking to take some shorts off the table, or where to look to short or get long. And then our regular reports come out on Tuesdays and Thursdays. That's where Woody gives us sentiment data as well as whatever he sees going on in the market. And then at night, I do daily video reports, just kind of recapping what's going on. And like I said, it's a great way to control your emotions. Everybody's just looking for some type of trading advantage in the market. And this is an advantage that not many people have. And it's why we have a lot of hedge funds and financial advisors that are members of ours, because they know it's kind of this kind of information you really can't find anywhere else. So if you're interested, like I said, just go to sentimenttiming.com, hit join, and then just use 2 weeks in the coupon code. And with that, if you guys, if you have any questions that you want me to answer, I'd be more than happy to take some answers, some questions, and I'll answer them as best I could. Now I'm not. Dave, are you still there?
Yeah.
Okay, so I'm not sure if I can't really see any if anybody typed any questions. I don't really see that anywhere.
Yeah, I'm not seeing any questions in the chat
Okay.
yet.
Well, that's pretty much all I have right now. Sorry, I'm a little bit short on the
All
time
right.
period.
No, that's fine. Yeah, we can.